Welcome to the DebtCircle podcast. Today is July 9th, 2026. We've got some exciting updates on the debt market that you won't want to miss. To start off, we'll discuss how a SIDBI has accepted bids for its over 3-year bond issue, signaling a notable move in the financial sector. Then we'll dive into the news about Nuvama Kusman's maiden fundraising an impressive 4,000 crore rupees, marking a significant milestone for them. And finally, we'll analyze Bajaj Finance's strategic bet on retail lending growth and what that means for the market going forward. So stay tuned as we break down these key developments in the debt space. SIDBI accepted bids totaling 80 crore rupees in their bond auction on July 8th, with a maturity of 3 years and 4 months and a coupon rate of 7.29%. The 80 crore rupees includes the base amount plus the green shoe option, reflecting robust demand. The dollar equivalent is around $840 million, using the exchange rate of $1 to 95.23375 Indian rupees.
That's significant. Such a medium-term bond with a AAA rating from CARE and CRISIL offers strong security, attracting investors looking for steady returns at a competitive yield. This issuance reinforces SIDBI's role in the debt market, providing a reliable investment backed by a government institution with top-tier credit quality.
Nuvama Kusman and Wakefield raised 4,000 crore rupees for their first fund targeting commercial office properties, exceeding the initial target of 3,000 crore rupees due to strong domestic investor interest. The fund has deployed about 45% of capital in Delhi, Chennai and Pune, covering 4 million square feet, with plans to double the portfolio size to 8 or 9 million square feet.
This reflects robust demand in Indian commercial real estate, with investment volumes up 189% year-on-year in early 2026, driven largely by domestic institutions and family offices. Their upcoming fund will diversify into data centers, logistics, and co-living, signaling a strategic move beyond offices to capture evolving investor preferences.
Bajaj Finance leverages its position within Bajaj Finserv to offer diverse unsecured loans, focusing on two-wheelers, consumer durables, and small-ticket credit for urban and semi-urban households. This taps into India's growing middle class seeking flexible credit. Their portfolio spans consumer, small business, and commercial lending, balancing growth with risk. Rigorous underwriting and collection frameworks help control non-performing assets amid interest rate and regulatory shifts.
This strategy suits market trends as consumer demand for affordable credit grows alongside digital adoption. Bajaj's broad distribution and brand strength enhance access, while digital platforms improve loan processing and customer reach. Non-bank lenders like Bajaj must stay agile. Their digital transformation, including app-based onboarding and merchant partnerships, boosts loan approvals and refines credit models, reinforcing competitiveness in India's retail lending market.
Let's move on to our next article. India's private credit market has doubled to approximately $25 billion by the end of fiscal year 25, driven by businesses seeking flexible funding beyond banks. So private credit fills gaps left by traditional lenders, offering customized financing solutions where loan tenors or sector exposure restrictions apply.
The limited competition from banks and non-banking financial companies due to regulatory and balance sheet limits supports continued growth for private credit providers. Exactly. This positions private credit as a key growth segment, attracting both domestic and global investors looking for alternative debt opportunities.
Afcon's infrastructure reported total income of 12,322 crore rupees in fiscal year 2025-2026, down 5.38% from last year, with profit after tax dropping nearly 48.5% to 250 crore rupees. The robust order book stands at 32,496 crore rupees, supported by new orders of 4,125 crore rupees and expansion into Croatia and Africa.
That decline in profit highlights industry headwinds. However, maintaining operating margins above 11% through cost controls shows resilience amid a tough market environment. This international growth and strong backlog should help stabilize revenues, even as the company plans to raise up to 250 crore rupees through non-convertible debentures for future projects.
State Bank of India raised over $1.5 billion through foreign currency deposits, offering interest rates up to 7.5%. The Reserve Bank of India fully covers hedging costs for deposits with tenures between 3 and 5 years, boosting participation. Depositors can leverage 9 times their own capital by borrowing from overseas banks at low rates, then deposit the total amount in India to earn higher returns.
This scheme targets the 35 million strong Indian diaspora, especially in the Middle East, Singapore, and London. With the Reserve Bank's backing, it strengthens India's foreign exchange reserves amid global tensions. Compared to last year's lower flows, this initiative quickly gained traction, mirroring a similar strategy from 2013 and analysts expect wider targeting to further grow foreign currency deposits, stabilizing the rupee.
Indian government bonds are under pressure, with the 6.94% 2036 bond yield fluctuating around 6.73 to 6.79%. This follows a sharp rise in the 10-year yield by 7 basis points, the largest jump in over 3 months, driven mainly by high oil prices near $80 per barrel and elevated US Treasury yields around 4.60%.
The geopolitical tensions after the US ended its ceasefire with Iran are pushing oil prices up, increasing inflation risks for India as the third largest oil importer. Meanwhile, expectations of a US rate hike in September keep Treasury yields elevated, reinforcing the pressure on Indian bonds. Despite these headwinds, foreign investors have bought net 365 billion rupees in Indian government bonds since early June, anticipating India's inclusion in Bloomberg's Global Aggregate Index. However, domestic overnight index swap rates have risen sharply, indicating tighter liquidity.
The Brihan-Mumbai Municipal Corporation holds deposits of 78,000 crore rupees at just 3% interest, while inflation runs at 7%. This means a real loss of 4% annually. BMC's deposits grew from 62,000 crore rupees in 2017 to 79,000 crore rupees in 2020, with a temporary peak at 89,000 crore rupees during 2022 and 2023, mainly from developers' advance premiums.
That's a significant gap. The Mumbai Metropolitan Region Development Authority invests its deposits in infrastructure, earning returns between 13 and 15%, effectively funding major metro and bridge projects without sacrificing liquidity. This shows potential for strategic investment rather than holding low-yield deposits, and with better deployment, BMC could generate higher returns and support urban development like MMRDA does.
Punjab and Sindh Bank has secured final regulatory approval from the International Financial Services Centres Authority to open its inaugural IFSC banking unit at Gift City, enabling offshore banking and foreign currency trade finance expansions. The bank's total business stood at 2,67,000 crore rupees, with a net profit of 1,322 crore rupees in fiscal year 26, aiming to cross 3 lakh crore rupees by March 2027.
This move strategically positions the bank to diversify beyond domestic markets, enhancing revenue through international lending and treasury operations, which aligns with rising market demand for global financial services. With improved asset quality and a capital adequacy ratio of 17.42%, Punjab and Sindh Bank is well placed to grow in international trade finance, improving margins despite current deposit cost pressures.
India has only 5.2 crore credit card holders, just 25% of the credit-active population of 25 crore. This penetration is much lower than Colombia's 62% or Hong Kong's 98%, showing credit cards aren't yet a dominant tool here. Despite this, credit card balances have surged 8.3 times to 3 lakh and 10,000 crore rupees, and ownership has expanded beyond metros to semi-urban and rural areas, with younger users increasingly adopting cards.
That low adoption reflects how UPI and personal loans are replacing credit cards, especially among first-time borrowers. Only 8% of new credit card issuances are to newcomers, down from 26% last year, as unsecured credit products grow. The geographic and demographic shift suggests gradual growth, but limited UPI linkage to Visa and MasterCard cards restricts wider use, keeping RuPay as the main card network integrated with digital payments.
Saturn Creditcare expects fiscal year 2026 to 27 assets under management growth of 15 to 20%, with credit costs between 3 to 3.5%. Their first quarter was the strongest ever, signaling potential to exceed these targets. They've also increased their non-microfinance portfolio share from 14 to 19%, aiming for 30% by 2030 through housing finance, MSME lending, green finance and tech ventures.
Strong first quarter in a traditionally weak period suggests positive momentum, though weather risks like floods remain a concern for repayment stability. This strategic shift, plus full geographic coverage including Kerala, underpins the 51% share price gain and market cap near 2,776 crore rupees.
Private sector banks are set to post 10% year-on-year profit after tax growth in Q1 fiscal year 2027, outpacing public sector banks' 9% rise. This is driven by stronger deposit growth of 14% compared to 11% in PSUs. Notably, private banks' net interest income is projected to grow around 10.4%, despite an expected 8% drop in pre-provision operating profit. HDFC Bank and ICICI Bank are forecast to see 8.5 and 10.5% NII growth respectively,
That deposit strength highlights better operating fundamentals for private lenders, even though PSU banks lead in loan book growth with 16.4% versus 15.9%. However, margin pressures remain, with sector credit growth at 17.7%, fueled by lower yield segments like gold loans. Provisioning might rise due to supply chain issues and tariff tensions, but net interest margins should stay mostly stable this quarter.
South Indian Bank's board will meet on July 16, 2026 to review first quarter results and discuss raising over 500 crore rupees through debt. This aims to boost their Tier 1 and Tier 2 capital for targeted credit growth in fiscal year 2026 to 2027. The bank's net profit for fourth quarter fiscal year 2026 was 340 crore rupees.
That aligns with mid-sized private banks securing long-term debt to lower liquidity risks and optimize their weighted average cost of capital. Investors may see a slight positive bias, but market reaction will hinge on the final capital raise quantum and AGM approval outcomes. Risks include interest rate volatility and potential asset quality issues, and the July 16th meeting is key to setting South Indian Bank's growth and balance sheet strategy for the new fiscal year. That wraps up today's update. Thanks for watching and stay connected with DebtCircle for the latest market developments.